Welcome to today's lecture. We are going to handle financial accounting on today's lecture. The topic for today's class is accounting concepts. The topic is what? Accounting concepts. In financial accounting, we have the accounting concepts that are used as a guide in the preparation of the accounts. Now, let us briefly define accounting concepts. Accounting concept simply means the set of generally accepted procedures and principles for preparation and presentation of what? Financial accounts. That is accounting concepts. The generally accepted accounting principles and conventions in the preparation and presentation of what? Financial accounts. This is what is called accounting concepts. That generally accepted accounting principles for preparation and presentation of financial accounting. It contains the procedures for the preparation of accounts. Today we're going to look at those accounting concepts. One, we have legal entity concepts. Legal entity what? Concepts. Two, we have going concern concepts. Going concern concepts. Three, we have dual concept, or there is double entry system. Double entry what? System. Then that is number three. Number four, we have matching concepts. We have matching concepts. Five, we have realization concepts. Realization what? Concept. Then the next one is what? Monetary concept. Monetary concept. There are about 12 accounting concepts, but we have listed 7 here. We're going to explain in the next class. We continue from the remaining ones. We're going to explain 3 out of the ones we have listed now because of time. 1, we're going to explain the first item there as the accounting concept. That is a business legal concept. There's business entity what? Concept. In business entity concept, it simply means that a system of accounting that recognize that accounting records or preparations are done in recognizing that the business is different from the what? The owner. Which means the owner of the business and the business is a different thing. Let's say Joy Nigeria Limited. Joy Nigeria Limited is a different person, while the directors of the company, or the owners of the company, they are what? A different person. So in legal entity concept, it recognizes that the accounts are prepared recognizing that the business and the owner are a different entity. They are a different person. The directors only invested in the business, while the business is an artificial person. That's why you have the right to enjoy the privileges of a person in a legal concept. When the business is registered as a limited, it means that the business and the owner is quite different. The director of the company who invested in the company are treated as a different person from the account of the company. So even if the directors comes to the business and borrow money, it is treated as a different accounting interest. It is not treated like if the owner of the business makes private expenses from the business income. The private expenses the owner of the business does is treated as a private business of the directors or the owner of the business, and not the business and not expense of the business as a company. That's what it means. So in the next class, we're going to look at some items that items we can use to illustrate the accounting treatment depicting where the business is recognized as separately different from the word business. So that is what is called legal entity what concept. It states that the owner of the business and the business are separate entities. They are different persons in the law. Then number two is what? Going concern concepts. Going concern concept is a very important concept in accounting. It simply means the accounting concept that recognizes that business is prepared in perpetuity. That business is prepared with hope that the business continues to live even when the owners of the business have died. Even when the owners of the business have died, the business continue to live beyond unforeseeable dates. That is what is called going concern concepts. And I would like to ask my student a question. If you are presented with a financial statement, how will you assess the going concern concept in the financial statement of an organization? Please bring the answers in the comment section and I will equally guide you. If the question is, as an accounting student, how will you assess the going concern concept of an organization or entity or a business on their financial statement? If you are presented with a financial statement of an organization, how will you assess that this financial statement is prepared based on going concern concept? It's a question. Please bring your comments on the down in the comment section. Then number 3, let's look at the double entry system. Double entry system is very important in accounting. That is, it encompasses everything you do in accounting. Double entry system is a system of accounting that recognizes that in every transaction, there is two parties, the buyer and the seller, the supplier and the buyer, the giver and the receiver. Let me recast it again in this class. Double entry system is an accounting system that recognizes that in every transaction, two parties are involved. The giver and the receiver. Now, the accounting treatment is that when there is two parties, one person must be the giver, while the other person will be what? The receiver. The accounting concept of double entry system recognizes that the giver will be credited. The giver will be what? Credited, while the receiver will be what? Debited. Let's say that Joy Nigeria Limited sells goods worth of 200,000 naira to Emeka. Emeka is a what? Receiver, while Joy Nigeria Limited is a what? The giver. The account of the giver is credited for giving out as a supplier, while the account of the what? The receiver, Emeka, is what? Debited with the amount of the goods he received. That is the 200,000 he received. That's accounting entry. Then when Emeka, there's the buyer that received the goods and the account was debited, when he pays, let's say he pays 150,000 naira from that amount, then when he pays 150,000, that 150,000 will be what? Credited to Emeka's account for giving out. While Joy Nigeria Limited, being a company that received, we're using as an illustration in this class, now the account of Joy Nigeria Limited will be what? Will be credited. Then will be what? Will be debited for receiving. Because the procedure is that in every transaction, two parties are involved, the giver and the receiver. The giver is credited, while the receiver is what? Debited. So in the next class, we're still going to illustrate the procedures in preparation of account using double entry principle. Double entry process is very important. And I would like the students to drop in the comment section the history of double entry system. To drop in the comment section the history of what? Double entry system. Any other questions concerning what you have explained now, please forward it to the comment section. Now, before I will now conclude, let's just summarize the lecture. We say that we have 12 accounting concepts. And in the 12 accounting concepts, we listed about 7, which include the going concern concepts, legal entity concepts, double entry system of accounting, matching concepts, realization concepts, monetary concepts, and many other accounting concepts that are there to make it to 12. So we now explain only 3 among these, the ones we have listed here. In the next class, we're going to continue to explain these items so that the student will understand the accounting treatment of these concepts and the procedures step by step. Thank you.